Welcome back, everybody, to today's Market Explained, a four-star podcast. Today, we will do our normal discussion about the markets and what's going on in the world. I have back with me my original co-host, Mr. Chris Reardon. Chris, welcome back.
Thanks, Brian. Good afternoon, everyone, and excited to talk a little bit about the markets.
And everybody knows Chris is the Director of Development for Four Star. He's a super guy. He manages all the portfolio programs and development programs of the firm. He's from Cleveland Indians fan, caretaker of his golden doodle puppy Hudson, and Chris has 3 kids under 2 years old. Unbelievable. Welcome, Chris.
Yes, 3 kids under 2 for probably 3 or 4 more months now.
4 months, that's right. And I'm Brian Castle, your host, CEO and CIO of Four Star Wealth, Eagle Scout, trustee of the National Boy Scout Foundation, chief dad to Quinn and Evan, and husband to the amazing Tripty. So if you like what we're hearing, what you're hearing, and what we're saying, please give us a 5 out of 5. You can do that on Apple iTunes, primarily is the one that does the ratings. And we'd appreciate that. And then send a copy of this podcast to your friends. Copy and paste, send it to them in a text. So we help increase our readership. We'd appreciate that. So Chris, let's talk about markets. We'll talk about the economy and what we see out there. Chris, what does it look like since the last podcast when Jack was our guest host?
Yep. So that was about mid-April. So now kind of coming into May, we have international equities still leading the way. It's at 249 tally points, and it lost 1 point. So relatively unchanged, still in that number 1 position. Number 2, we have commodities. It's at 209, and it's only lost 1 point as well. So not too much of a shakeup. Cash is still holding that number 3 position at 195, and it's equal from the last podcast. And domestic equities is in the 4th position. It's at 182 tally points, and it gained 1 point since the last podcast. Fixed income is at 130 in the 5th position there, and it's lost 3 points from the last podcast. And still in last, we have currencies at 122, and it gained 3 points from the last podcast. So relatively muted from an asset allocation perspective. I don't think that's too much of a surprise. It's really been a very up and down market these last few weeks, even to a month. So not a whole lot of change relative to each other, but certainly we still have international equities by far the number 1. Commodities is still, I would say, solidly in that number 2 position, but cash isn't too far behind.
Yeah, so the big story really in the last month or so has been the move in commodities. Since our last episode, there was only 1 negative tally point, but to get to 209, we had a couple big moves back up. Commodities had faded to position 4. Now they're 2, threatening to become number 1 again. International equities have been strong because of our debt level, the dollar is waning. We're seeing discussions about the world settling oil transactions in different currencies now. So the dollar is getting a little weaker. So we saw those currency moves that moved up. International stocks would do better in a weak dollar environment also. So that's holding in there at number 1. But commodities are also coming back. But we'll see what it looks like for the next move. But it's still precious metals primarily, and not agriculture anymore. So that's really kind of what's happening. Last year, the commodity moves were all about energy and agriculture. This year, it's mostly about precious metals.
Mm-hmm. Yeah, I mean, I would say one of the big drivers that's causing a lot of volatility is a lot of the eyes of the world really are on China, which is supposed to be reopening. Is that going to be what the expectations are? Is it going to be, kind of come in less than expected? That's driving the international equities. That's obviously a big driver there. And also commodities. China is the biggest consumer of commodities. So if they decide to go into a building mode or really fully open up the country, that'll be a big boon for commodities. So the eyes of the world right now really are on kind of what's going to be going on.
Exactly. Well, and then more domestically, travel is still strong. We're seeing, if anybody's tried to book a flight lately, travel prices are out of this world. Restaurants have still been strong, so consumer spending is holding up, and the consumer discretionary spending, which is restaurants, usually doesn't hold up when the economy is slowing. But we are seeing a slowing in the economy. The GDP numbers were lesser than the previous. We'll get into that in a minute. And also, we're seeing home building and construction as strong. You usually don't see that, Chris, when the economy is slowing down. But what we're seeing, though, is we're seeing a shift from certain states, high tax, regulation states, to more kind of capitalistic states. People are moving to, Florida, Arizona, Texas, and out of big high tax states like California, Illinois, and New York. So that's why home building's continuing, because they need lots of homes. Plus, we did go through the worst bear market in America's history in the housing market from 2005 to 2012. So we're still trying to make up for that. All these years later, there's a shortage of housing for the population growth. So all those factors together are leading to home building boom again here, even though we're seeing a slowdown in the economy.
Yep. Yeah. I mean, I think that kind of hits the nail on the head. Yeah, I think there's also some underlying trends. I think the formation of families and households in the millennial generation has kind of accelerated as of late. And I think the COVID pandemic as well reversed a trend that was going on for almost a decade, where people were kind of moving to the city. We certainly have that kind of being revitalized again, but certain cities, there's been an increase in violence, things like that. So we've seen more of a movement towards, in some cases, in some areas, the suburbs. And with that flow, there wasn't a good supply of houses or single family homes. So, we're having this rush of builders trying to catch up with, if you will, new trends that are happening.
Yeah. So now it's interesting. Now that we've seen the markets stabilize a little bit this year, with the tech stocks bouncing back, but again, it's so bad last year that even though they're up in the mid-teens percentage-wise for the year, to make up for the big losses they had last year, where the tech index, NASDAQ, was down 33, some of the big techs down much more than that. So, a 10 or 15% move upward doesn't make up for all the losses from last year, but it's nice that it's up a little bit this year. And the other indexes are up just single digits, 3-4%. And that happens in bear markets anyway. So the market right now is trading at 18 times earnings, Chris, and 18.8 times earnings. And that's historically on the expensive side of the market. The worst decline in American history was the 1970s. And that's when the multiple ended at 8 times earnings. So stocks were really, really cheap. And then the 2009 debacle, when the market collapsed, then we got down to about 9 times earnings, not quite 7. So we're at 18 times earnings. The average over time is 15 times. So we're above average. So usually that market doesn't bottom at those levels. So many strategists are predicting we're going to have a downturn. But 71% of companies are beating their estimates. So it's really kind of cross currents. It's a very strange environment. Money supply is contracting. The Fed is still tightening. They raised interest rates again, the Fed funds rate 25 basis points on Wednesday this week. And that's the 10th consecutive increase. And the Fed's doing that to ward off inflation. So their hope is that they can get rid of inflation without bringing the country into recession, but they might bring the country into recession. And that's what it looks like right now. So Chris, why don't we turn to the economy? And you've got a whole bunch of numbers for us. Let's hear what's going on.
Yeah. So as you kind of alluded to earlier, Brian, we got the U.S. GDP number for the first quarter. It came in at 1.1%. That was down from 2.6%, which was the Q4 2022 reading. So it did slow down considerably. I would say the one bright spot is personal consumption expenditures rose 3.7% in the first quarter. So consumers are spending more on goods and services. So that's the one I would say one of the big bright spots is that the consumer, at least so far, has still seemed relatively resilient. I think the concern that people are predicting is how long can the consumer remain resilient? And once that starts to lag, are we going to see that GDP number start to dip? We don't know for sure. I think the consumers remained more resilient than some economists certainly expected. But it's certainly something to look forward as we go into Q2, Q3 of this year.
Right.
On the home front, so the S&P CoreLogic Case-Shiller National Home Price Index, which is obviously just a fancy way of saying the average price of a home across the United States, rose 0.2% in February from January, and that snapped a 7-month streak on month-to-month declines of home prices. Obviously, with interest rates rising, in most cases, we've seen the price of homes pull back slightly. But we have kind of a big tug and pull going on in the housing market now. On one end, you do have higher interest rates, which make purchasing a home much more expensive, make that monthly payment a lot more expensive. But on the flip side of it, supply is extremely low. A lot of homeowners currently are locked in at low interest rates. There's a big gap there of wanting to sell unless you are really forced to move. So really interesting things going on in the kind of home ownership market, if you will, the real estate market.
Yes.
On the flip side of that, the U.S. existing home sales, so not necessarily price, but the volume of sales decreased 2.4% in March, month over month. And they were actually down 22% from the prior year. This might be a little bit of an extreme. For those of you that remember last year, we saw a big kind of spike towards the end of March, April, and even kind of into May, as a lot of homeowners really scrambled to try to get into homes before interest rates were raised too high. So we kind of have probably, if we go back a year, you have almost an extreme upside. And obviously now we're kind of on the flip side. We have almost an extreme low volume being brought out there. So it'll be interesting to watch, especially in a couple months as things really start to mellow out, kind of midsummer to fall, as we really kind of more normalize out what that number becomes.
Mm-hmm.
The wholesale price of diesel recently fell to $2.65 a gallon, and that's actually down from the May 2022, so a year ago roughly, a high of $5.34, almost half the price of diesel per gallon. This has mostly been driven by a nationwide freight slowdown we've seen. A lot of this has come as a lot of industries and businesses are kind of preparing for a slowdown. So we're seeing a decrease in maybe orders or industrial production. So we're seeing some slight tightening there. And supply and demand obviously would constitute there that we're going to see a drop if there's a slowdown in demand in the price. So
yeah.
The U.S. Bureau of Labor Statistics came out and found that markups on new cars, so dealerships that brought out new cars were marking them up above maybe what their MSRP was. They were a major factor in the inflation that the U.S. experienced over the last couple of years. So what they found out is extra dealer markups alone. So not only, maybe the price that was being sold to them was increased, their markups on top of that alone contributed between 0.3 and 0.5 percentage points to the nearly 16% rise we saw in CPI between end of 2019 and the end of 2022. So although that might seem as a small significance compared to 16%, when you really think about it, just a small little markup that the dealership's putting on it, accounting for that's a really large number when you really think about it. So really interesting, and I'm sure there's going to be more that impacted the inflation we've seen over the last. Employers spent 1.2% more on wages and benefits in the first quarter from Q4 2022. Who led this wage gains was mostly in-person service roles. So that was mostly construction, maintenance, leisure and hospitality, and hospital workers. So we really saw larger bumps on in areas and employment areas where you had to be in person to perform the role. You can't really remote in. You can't do anything that with construction, obviously, or leisure and hospitality. So a lot going on in the U.S. market. Obviously, more and more economic data is being unpacked, I would say. And so it'll be interesting to kind of track these trends, especially in the housing market, kind of moving forward through 2023.
Yeah. So you talked a little bit about foreign now too, China, EU.
Yep. I guess, and then on the international front, as we kind of talked about in the beginning, a lot of the eyes are on China and some of their economic numbers and whether there's going to be a slowdown there or we're going to see reacceleration. So China's Purchasing Managers Index for non-manufacturing sectors. So this is a good example of, like buying clothing, things like that. That came in at 56.4 in April, which was weaker than the March reading of 58.2, but still well above that 50 level. So people are watching this closely because obviously China is, I think now at this point, the second most populous country. I think India surpassed it. But obviously one of the most populous countries in the world. So big consumption there from their consumers. So a big driver of world GDP and a big consumer there. So it's interesting to watch. And if they are accelerating, that'll be good for overall world growth. The EU GDP rose at an annualized rate of 0.3% in the first quarter. That's very important because it actually shrunk by 0.2% in Q4 of 2022. So they very, very nearly missed a recession, or technical definition of a recession, which is 2 quarters of decline. So that's positive. I mean, I think overall, I think it does showcase that the EU as a whole is definitely weaker as of right now than the US. And that has allowed the US to obviously be a little more aggressive in the rate hikes. But I think on the positive front, it seems like they're at least holding for right now. We're not seeing complete economic collapse by any means out of the EU, at least as of right now. On that front as well, the ECB came out this week and raised their main deposit rate 25 bips to 3.25%, which once again is about 2 percentage points behind the US rate. But still, if you take into consideration the fact that for a certain period of time, the EU had even negative interest rates, that's a pretty substantial hike, I would say, in some cases on par with the US. So we're seeing aggressive monetary policy really from around the world to rein in inflation and kind of bring things under control. So it'll be, once again, interesting to watch. I think obviously international right now has been a big driver. A lot of it's due to currencies, dollar strength, things like that. But it's something going to play an important factor for the rest of 2023, for sure.
Exactly. Well, that's great, Chris. It's interesting. The Europe markets have been weaker economically than the U.S. for quite a long time, and it appears to be structural. They've got much higher taxes. They've got a lot more regulation. So there is a move afoot in certain countries in Europe now to dismantle a lot of that big deep state, heavy tax, heavy regulation environment. Certainly in Italy, there's a new prime minister lady who is doing some of those things now. So there's other countries where some of the trends are changing and coming back more toward capitalism rather than more socialistic trends like the northern countries in Europe. So it'll be interesting to see how that plays out. And America seems to be kind of going in the opposite direction. We're going for more socialistic policies and things like that. So we'll see if we can come back from the brink of socialism here in America. And then, Chris, one other thing I wanted to add to the economic discussion is there are different indicators that the Federal Reserve tracks to see what the economy is doing. And some of those indicators they call leading indicators. Leading indicators are the ones that turn down first, and then some are lagging. So there's leading, coincident, and lagging indicators. So leading indicators are now pointing as bad as they were in 2008 and in 2020. The index of leading indicators have now declined 7 months straight. So usually when that happens, we do have a recession. The continuing claims of unemployment are as bad as they were in 2008 and 2020, even though we've had a decent labor numbers. Now, we also know that last year, the government admitted that they were overestimating employment. And so maybe they're doing that again. There was almost 1 million job divergence between the household survey and the Labor Department's numbers. They brought them back together at the end of the year. So we're not sure why that happened, but maybe that's happening again, because it seems like the today's employment number was better than expected. So while we're seeing continuing claims as bad as they have ever been. So it's a very strange, usually don't see those things happening at the same time. The labor market under the surface is deteriorating. And I think you mentioned this before, Chris, they're replacing a lot of high-tech, high-paying jobs with low-level labor jobs. But that's the area where there has been job growth in in the market. So labor in general is now kind of waning. The labor market is deteriorating. So we'll see what happens there. Goldman Sachs, Chris, estimates that their GDP number for 2023 will be 1.2%. So that's below last year. It's below what we normally see in a growth market. So that could be a mixture of down quarters and up quarters to come to 1%. So we'll see what things look like as we go forward. And then for what we see out there, there's a bunch of different things going on. Chris, you saw the thing about the SpaceX.
Yeah, so really cool. SpaceX launched their largest, the largest, I believe, rocket ever built. The rocket successfully lifted off before exploding, I think, far up in the atmosphere. But overall, I think it was seen as a success. I think it was first time it's a rocket of that size has ever been launched. They had this big concrete structure below the launch pad, and actually absolutely destroyed this big concrete structure that was supposed to be able to handle this kind of takeoff, and hurled chunks of concrete miles away. So this rocket's actually what is supposed to take any astronauts eventually to the moon and eventually Mars. It actually has the capability and the power to carry people to Mars. So I think it's obviously a step in the right direction on that front, and it's, I think, extremely cool. On top of that, came out today, the World Health Organization has officially put an end to the COVID pandemic emergency. Obviously, things have been relatively back to normal I would say this year, and even towards the tail end of last year. So I think it's no surprise there, but it's good to see we're kind of at least finally putting everything in the books. Everyone's kind of, agreeing that it was all over. In Sudan, the U.S. has pulled all diplomats and U.S. personnel out of the country as fighting has now increased between two rival generals, one who's in control of the Sudanese army, and another one who controls the Rapid Support Forces, which is Sudanese. Really interesting out of there. We're seeing some volatility. Yeah. And then last thing I'll mention is tomorrow or Saturday, May 6th, we're having the running of the 149th Kentucky Derby. So we're going to see a lot of large hats. And, usually I think a lot of people take that as kind of a kickoff to summer, warmer weather coming. It's always a good sign.
Nice. Well, good luck, everybody, at the Kentucky Derby. Hey, Chris, back on that space theme, I keep seeing articles from the University of Chicago magazines all about potential space travel for citizens. They had a crew that went up with Michael Strahan, the famous football player and now TV host. Jeff Bezos went up with a crew as well. So there's all kinds of talk about space travel. I had an interesting experience last month. We met with Captain James Lovell. Captain James Lovell was the commander of the Apollo 13 mission. We met with him on the 53rd anniversary of the Apollo mission launch. The purpose of that, I'm involved with the Boy Scouts of America, and I was part of a contingent that went to present Jim Lovell with the Distinguished Eagle Award from the National Eagle Scout Association. So we got to meet him, and he talked all about how when he was out on that mission, they thought they might die. They thought they might not recover. And everyone has seen the movie and heard the whole story about it and how they got back to America. He figured out how to get back to America with a slide rule, or back to Earth with a slide rule. But they figured out they had to go around the backside of the moon. And so if you're into space, you might know this, but when you look at the moon doesn't change. The moon is always the same view, because the moon doesn't rotate. So it rotates around the Earth, but the side of the moon we see is always the same side. So very few people see the back side of the moon or the far side of the moon. And anybody who was around in the 70s remembers the Pink Floyd song about the dark side of the moon. Well, Jim Lovell's one of only 3 people that's seen the dark side of the moon, because they actually had to go around the dark side of the moon to get back to Earth and propel the ship back to Earth using the moon's centrifugal force. So they pulled that off. So that was a great experience. And I talked to Jim briefly afterwards about it, and he was very excited about all the great space travel that's happening now. So we're into space. We have all kinds of, articles about space travel and space involvement. So maybe in our lifetimes, we'll see people kind of traveling up to space, just doing a tour around the Earth just to see it. And I'd be up for it. We'll see if we can do it. So we're always famous about space travel. So that was a great experience meeting Jim Lovell and getting spent an hour with him talking about the mission and all the things that happened. So anyway, moving on though, just on other things, what we see out there, the Biden administration is proposing new rules now that if you have good credit, they're actually going to tax you more to incent to give that money and lower the rates for people with worse credit. So it seems like they're going in the wrong direction there, because that basically gives people the incentive to have bad credit. So if you have bad credit, then you get benefits. So you have good credit, you get taxed more. And usually the opposite way. Usually you get benefits for having better credit. So those rules might go into place very soon. And so I know there's going to be pushback on that. We're also seeing, Chris, a meltdown in the banking industry. So all these interest rate increases are causing trouble for the banks in two fronts. One is they have lots of mortgages, and they were writing mortgages at 2% and 3%. Now the mortgages are at 5%, 6%, and 7%. So then, and the cost of money is much higher than what they're getting on the mortgage. So they're actually underwater on a lot of the mortgages. So then interest rate increases are also causing trouble for commercial real estate. And so commercial real estate, because of the pandemic as well, people aren't coming back to the cities as much. So that's causing trouble for the banks because they have lots of loans that are now defaulting. In the real estate sector, there was an article about a property in San Francisco that was worth $300 million before the pandemic, and it's going to be trading here shortly at about $60 million, or down 80% in value, because people aren't coming back to the office. So the banks own those loans, and so the banks are having trouble with the higher interest rates. They're having trouble with commercial real estate losses. So we're seeing people fleeing banks. Ironically, in 2008, when things were very rough, they took the entire securities industry and gave them FDIC insurance. And at that time, that was to quell the concerns with the investment banks. Well, now having FDIC insurance is seen as somewhat as a negative, because it's only up to about $250,000. And so people are pulling their money out of banks. So we're seeing Silicon Valley Bank collapse, Signature Bank, now First Republic. They're all tech-related banking organizations. There's another one called PacWest that's under fire right now. So more and more banks are merging into JP Morgan and other larger organizations. So I think we might need a new model. So let's talk about why that's happening. If anybody remembers the Jimmy Stewart movie, It's a Wonderful Life, and people were standing out in front of the bank trying to get their money out. So it took days and days and weeks for a bank run, because people had to physically go to the bank to get their money and withdraw their money. And Jimmy Stewart was making the presentation that, don't pull your money out. Your money's in Joe's home and Tom's home and all the neighbors that were in line. Your money's safe. Your money's with all these other places. So don't worry about it. Don't pull your money out. It's safe and you're fine. And they tried to quell the bank run back then by doing that. Now, with just a click of your phone, you can move, thousands and tens of thousands and hundreds of thousands of dollars from one bank to another very, very quickly. So Silicon Valley Bank had 40 billion leave over a period of 2 days. Some of the other banks have had similar runs. It's all done by computers. So technology is great. Technology has created efficiencies, but the efficiencies may be too much for the banking system, as people are pulling money out so quickly the banks can't protect themselves. So they may have to create a new model for banking. So that's positive for technology and certainly a negative for the bank. So we'll see what's finally decided there. Then just some other things we wanted to share with you. The NFL draft came out, and we saw increasing salaries for all the players. So that continues to go up. All the players in the NFL are making more and more money. We're seeing precious metals are still running. And then I did want to mention one other thing that we think is very concerning, and that we called it earlier in an earlier episode, the toxic game of chicken. So that's between the president, President Biden and Congress. So the Republican Congress, under Kevin McCarthy, has proposed a debt ceiling bill to increase the debt ceiling about $1.5 billion. So obviously we don't default on our debt, but they're asking for spending cuts because we got there by overspending, and we're going to have projected to be a $2 trillion deficit this year, Chris. So they want to cut that down. There's a lot of authorized spending from the pandemic that's not been spent. They want to get rid of that spending as well because we're overspending and we're adding debt at record levels. The Congressional Budget Office just recently met with a number of top leaders in Congress and said they basically have about 10 years to solve this problem, or we will be in structural default. We won't be able to pay our debts because the interest rates are higher, and it will crowd out any other spending. So by having more and more debt, we may end up reducing government services because they can't tax the public much more. I mean, people are moving from state to state to avoid taxes. People will leave the country if they keep getting tax increases. So we need to do something about it. And the Congress is suggesting spending cuts. The president won't budge because he doesn't want to be responsible for spending cuts. So this is a toxic game of chicken. Show me your deal. I'll show you my deal, but then they're not. So we have until June 1st when we go into technical default. Now, we're not going to default on our debt, but there's all kinds of recriminations and complaints on one side or the other. So I call it a toxic game of chicken, and the toxic game of chicken continues, Chris. So we've got about a month till they can come to the table. Apparently, they're going to meet now, President Biden and the Congress, on May 8th or 9th, and then they're going to try and resolve some of their issues. But they're already posturing about that meeting, right? So we'll see what Congress does. So that's really not a great development, but we wanted to report on that. And that could create more volatility, Chris, in the markets, as we see volatility factors start to pick up as every other day we get some report of what Congress did, what the president did. So we're constantly dealing with that right now. So let's hope they resolve that, everybody. That's a big problem.
Yep, I would agree.
So that's all we have today. I just wanted to highlight, we have some blog posts. There's a blog post about spending, and many investors, create a budget and they create a financial plan, and then they don't follow it as well as they should. And if you think about, how do you think about spending? When you're spending when you're out, at a store, you're spending at different times, and many people don't keep in mind what their budget is when they're actually spending. So there's ways that we spend that may not relate to our financial plan. There's a whole article about the heuristics about how people spend and what they think about when they're spending. And it's something to consider when you're out spending and all of a sudden maybe you spent too much, you paid too much for this, or you bought too many things, and you were really thinking about your overall plan. So there's an article all about that, how people think and how they spend. Then there's another article also up there about taxes. And we tend to pay taxes in a lot of areas, whether it be in, cigarette taxes, gas taxes, all different types of taxes, and income taxes. But what they've shown through a study is it really depends on how the taxes are presented to us. So if taxes are part of the good that we're buying, well, then we don't even see it, and we spend money on taxes. But then if we get a bill for taxes, we might avoid the bill. Or if they will not allow you to buy something until you agree to a tax, and they highlight it and make it separately so you can see it, well, then maybe we're not going to make that decision. But if it's hidden inside the good, then we might pay for that anyway. So they've done some studies on how we react to taxes, and a lot of it has to do with how taxes are shown to us. So there's an article up on our website about that, on the Leadership Matrix, so the 4starwealth.com, and the blogging sites, the Leadership Matrix. So have a look at that, and we sent that out to all our clients as well. So that's I think that's all we have. We did have an interview with Brian Smiga in the previous podcast interview. He's an investment banker updating us on what's going on in the capital markets. Things are slowing down. So Brian, very interesting comments about that as well. So feel free to listen to that. Chris, I think that's all we have for today.
Yeah, I would agree. I think that's all we got.
Okay, thanks everybody for being with us again on today's Market Explained. We'll be back again with an interview episode and then also market commentary. We'll see what things look like in a couple of weeks. Thanks everybody for being with us today.